Question 1. A life insurance policy owner in California, age 62, purchased a variable universal life policy. What is the minimum free look period required for this policy? A. 10 days. B. 20 days. C. 30 days. D. 60 days. Answer: C. 30 days. In California, the standard free look period for most life insurance policies is 10 days. However, for individuals age 60 or older, and for policies like variable life or annuities, the minimum free look period is extended to 30 days. This extended period allows seniors and those purchasing more complex investment-linked products additional time to review their decision and cancel the policy for a full refund if they change their mind. This rule provides an important consumer protection, ensuring buyers have ample opportunity to understand their significant financial commitment. Remember, always assume the longer free look period applies when dealing with seniors or variable products. Question 2. Under California law, a life insurance agent offers a client free tickets to a professional baseball game in exchange for purchasing a life insurance policy. This act is considered A. An acceptable sales incentive, if disclosed. B. An allowable promotional expense, if approved by the insurer. C. An act of rebating, which is prohibited. D. A permissible non-monetary gift, if its value is minimal. Answer: C. An act of rebating, which is prohibited. Rebating is an illegal practice in California and many other states where an agent offers something of value not specified in the policy as an inducement to purchase insurance. Offering free baseball tickets in exchange for a policy purchase falls under this definition because it is a special favor or advantage not available to all insureds and not outlined in the policy. This practice is prohibited to ensure fair competition among agents and to protect consumers from being swayed by inducements rather than the merits of the policy itself. Always remember that any offer of value outside the policy terms, whether money or gifts, is likely a prohibited rebate. Question 3. An individual applied for a life insurance policy and was informed by the insurer that they would need to undergo an HIV test. Under California law, which of the following is required before the test can be administered? A. The applicant must sign a general consent form for medical examinations. B. The insurer must provide a written disclosure statement explaining the purpose of the test and obtain written informed consent. C. The applicant must provide a verbal agreement to undergo the test. D. The agent must verbally explain the test and document the conversation. Answer: B. The insurer must provide a written disclosure statement explaining the purpose of the test and obtain written informed consent. California law imposes strict requirements regarding HIV testing for insurance purposes, prioritizing applicant privacy and informed consent. Before an HIV test can be administered, the insurer must provide a detailed written disclosure statement explaining the purpose of the test, how the results will be used, and confidentiality protocols. The applicant must then provide explicit written informed consent, acknowledging their understanding and agreement. This stringent process ensures individuals are fully aware of what they are consenting to when undergoing sensitive medical tests for insurance. Always remember that specific written consent is paramount for HIV testing in California. Question 4. A beneficiary designation in a life insurance policy reads, "To my children, per stirpes." If one of the insured's children predeceases the insured, what happens to that child's share of the policy proceeds? A. It is distributed equally among the surviving children. B. It reverts to the insured's estate. C. It passes to the deceased child's heirs. D. It is paid to the contingent beneficiary. Answer: C. It passes to the deceased child's heirs. The phrase, per stirpes, is a Latin term meaning, by branch, or, by roots, indicating that if a named beneficiary dies before the insured, that beneficiary's share of the proceeds does not disappear or get redistributed among the surviving named beneficiaries. Instead, it passes down to their legal heirs, example their children, essentially following the family tree. This ensures that the deceased beneficiary's descendants receive what their parent would have inherited. Understanding per stirpes versus per capita, which means per head, where the share is divided equally among surviving beneficiaries, is crucial for proper beneficiary designation. Question 5. Which of the following is the primary purpose of the California Life and Health Insurance Guarantee Association, CLIGA? A. To prevent insurer insolvencies through financial oversight and regulation. B. To protect policyholders and beneficiaries in the event a member insurer becomes insolvent. C. To promote consumer education regarding life and health insurance products. D. To mediate disputes between policyholders and insurance companies. Answer: B. To protect policyholders and beneficiaries in the event a member insurer becomes insolvent. The California Life and Health Insurance Guarantee Association, CLIGA, serves as a safety net for policyholders, providing a certain level of coverage if a life and health insurance company licensed in California becomes financially insolvent. While the Department of Insurance focuses on preventing insolvencies through regulation, the CLIGA's role is to step in and pay covered claims, up to specified limits, when an insurer fails. This mechanism helps maintain public confidence in the insurance industry by ensuring that eligible policyholders do not lose all their benefits due to an insurer's financial collapse. Think of CLIGA as a protective fund that kicks in when an insurance company goes out of business. Question 6. An agent is replacing a client's existing whole life insurance policy with a new one. Under California replacement regulations, which of the following is not a duty of the replacing insurer? A. Sending a copy of the notice regarding replacement to the existing insurer. B. Maintaining copies of the replacement notice and verification for at least 3 years. C. Providing the applicant with a copy of the new policy within 10 business days of application. D. Notifying the existing insurer of the replacement, providing the applicant's name and identification information. Answer: C. Providing the applicant with a copy of the new policy within 10 business days of application. While a new policy will eventually be issued, providing the applicant with a copy of the new policy within 10 business days of application is not a specific duty of the replacing insurer under California's replacement regulations. The core duties of the replacing insurer involve ensuring the applicant receives the notice regarding replacement, notifying the existing insurer of the impending replacement, and maintaining detailed records. These regulations are designed to protect consumers from potentially disadvantageous replacements by ensuring transparency and proper disclosure, allowing the existing insurer to inform the policyholder of potential drawbacks. Question 7. What is the maximum fixed interest rate that an insurer can charge on a life insurance policy loan in California, unless a variable rate is specified? A. 6%. B. 7%. C. 8%. D. 10%. Answer: C. 8%. Under California law, a life insurance policy that permits policy loans must include a provision stating the maximum policy loan interest rate. If a fixed rate is used, it cannot exceed 8% per year. However, policies may also offer a variable loan interest rate, which is typically tied to a recognized index. This regulation ensures that policyholders are not charged excessively high interest rates when borrowing against their policy's cash value, providing a predictable cost for accessing their funds. Remember that fixed policy loan rates in California are capped at 8%. Question 8. A policyholder allows their individual life insurance policy to lapse due to non-payment of premium. In California, what is the minimum grace period that must be provided before the policy terminates? A. 30 days. B. 31 days. C. 60 days. D. 90 days. Answer: C. 60 days. While many states require a 30-day or 31-day grace period for individual life insurance policies, California mandates a minimum grace period of 60 days. This means that if a policyholder misses a premium payment, the policy remains in force for 60 days beyond the due date, during which time the premium can still be paid without the policy lapsing. This extended period offers a significant consumer protection, giving policyholders more time to make payments and avoid an unintentional lapse in coverage. Always note that California often has longer consumer protection periods than the national average. Question 9. Which of the following statements regarding the incontestability clause in a California life insurance policy is false? A. It generally prevents the insurer from denying a claim due to misstatements in the application after 2 years. B. It applies to misstatements of age or gender made by the insured. C. It does not apply to a fraudulent misstatement of a material fact. D. It helps provide policyholders with assurance that their beneficiaries will receive proceeds. Answer: B. It applies to misstatements of age or gender made by the insured. The incontestability clause states that after a policy has been in force for a specific period, typically 2 years in California, the insurer cannot deny a claim based on misstatements made in the application, even if they are material. However, this clause has exceptions. It explicitly does not apply to fraudulent misstatements or to misstatements of age or gender. For age or gender misstatements, the policy proceeds will simply be adjusted to the amount that the premium paid would have purchased at the correct age or gender, rather than the policy being voided. This clause provides security for beneficiaries but does not protect against outright fraud or simple factual errors in age/gender. Question 10. A policy owner has a $100,000 whole life policy and decides to utilize the reduced paid-up non-forfeiture option. Which of the following accurately describes the outcome? A. The policy's cash value is used to purchase a term policy of the same face amount for a limited time. B. The policy is converted to a paid-up whole life policy with a lower face amount than the original. C. The policy's cash value is paid out to the policy owner, and the policy terminates. D. The policy continues for the original face amount, but the policy owner must continue to pay premiums for a reduced period. Answer: B. The policy is converted to a paid-up whole life policy with a lower face amount than the original. The reduced paid-up non-forfeiture option allows a policy owner to use the existing cash value of a lapsing whole life policy to purchase a new, fully paid-up whole life policy with a reduced face amount. No further premiums are required, and the coverage continues for the insured's entire life. This differs from extended term, which uses the cash value to purchase a term policy for the original face amount for a specific period, or cash surrender, which pays out the cash value and terminates the policy. It's a way to maintain some permanent coverage without further premium payments. Question 11. An agent sends out a mass email advertisement for a new life insurance product. The email includes a comparison of guaranteed versus non-guaranteed elements of the policy. Under California advertising regulations, which of the following is true regarding this comparison? A. Non-guaranteed elements may be presented with equal prominence to guaranteed elements. B. Illustrations of non-guaranteed elements must be clearly identified as such and not be misleading. C. Any illustration of non-guaranteed elements is strictly prohibited in advertisements. D. Only guaranteed elements can be shown in initial mass market advertisements. Answer: B. Illustrations of non-guaranteed elements must be clearly identified as such and not be misleading. California advertising regulations permit the inclusion of non-guaranteed elements, like dividends or projected cash values, in life insurance illustrations and advertisements, but only under strict conditions. These non-guaranteed elements must be clearly labeled as such, be based on reasonable assumptions, and not presented in a manner that could be misleading or imply they are guaranteed. The goal is transparency, ensuring consumers understand which figures are certain and which are projections. This protects consumers from being misled by overly optimistic future projections that might not materialize. Question 12. Which of the following accurately describes the primary characteristic of a modified endowment contract, MEC, under federal tax law, as it applies to California life insurance? A. It is a life insurance policy that has been issued to an individual over age 65. B. It is a life insurance policy that fails the 7-pay test, resulting in less favorable tax treatment of distributions. C. It is a life insurance policy that has a variable investment component. D. It is a life insurance policy used primarily for retirement planning. Answer: B. It is a life insurance policy that fails the 7-pay test, resulting in less favorable tax treatment of distributions. A modified endowment contract, MEC, is a specific designation given to a life insurance policy that, for tax purposes, loses some of the tax advantages of a traditional life insurance policy. This occurs if the cumulative premiums paid into the policy exceed the 7-pay test limit, which is the total amount of premium that would have been required to pay up the policy in 7 years. If a policy becomes a MEC, withdrawals and loans are taxed on a last-in, first-out LIFO basis and may be subject to a 10% penalty if taken before age 59.5, making it less attractive for cash value access. The 7-pay test exists to prevent policies from being used primarily as investment vehicles rather than for their intended death benefit purpose. Question 13. All of the following are typically included as standard provisions in an individual life insurance policy in California, except A. Entire contract provision. B. Misstatement of age or sex provision. C. Conversion privilege from group to individual. D. Reinstatement provision. Answer: C. Conversion privilege from group to individual. While an individual policy may offer a conversion privilege if it originated from a group policy, the conversion privilege from group to individual is a standard provision found in group life insurance policies, not individual ones. The other options listed, entire contract, misstatement of age or sex, and reinstatement, are all common and often mandatory standard provisions found within individual life insurance policies. These provisions define the rights and obligations of both the insurer and the policyholder, ensuring clarity and fairness in the policy's operation. Question 14. An agent is trying to convince a policy owner to surrender an existing life insurance policy and purchase a new one, solely for the purpose of earning a new commission, despite the new policy offering no clear benefit to the client. This unethical practice is known as A. Rebating. B. Twisting. C. Churning. D. Defamation. Answer: C. Churning. Churning is an unethical and illegal practice where an agent induces a policyholder to lapse or surrender an existing policy and purchase another policy with the same insurer, primarily for the purpose of generating a new commission for the agent without any justifiable benefit to the policyholder. This differs from twisting, which involves persuading a policyholder to replace a policy with a different insurer. Both are prohibited practices under California law because they exploit the client for the agent's financial gain. Agents should always act in the client's best interest, not their own. Question 15. A participating life insurance policy owner opts to use their dividends to purchase paid-up additions. What does this dividend option accomplish? A. It reduces the annual premium for the existing policy. B. It increases the policy's cash value and death benefit. C. It allows the policy owner to receive the dividend in cash. D. It purchases a separate 1-year term policy for the dividend amount. Answer: B. It increases the policy's cash value and death benefit. When a policy owner chooses the paid-up additions dividend option, the dividends are used to purchase small, single-premium whole life policies. Each paid-up addition generates its own cash value and adds to the overall death benefit of the original policy. This is a popular option for policyholders who want to maximize the long-term growth of their policy's value and increase their death benefit without paying additional out-of-pocket premiums. It's a strategic way to leverage policy dividends for enhanced policy benefits. Question 16. In California, which of the following is not a characteristic of a qualified plan for retirement savings? A. Contributions are often tax-deductible. B. Earnings grow on a tax-deferred basis. C. Distributions are typically tax-free upon retirement. D. Must meet IRS requirements to receive favorable tax treatment. Answer: C. Distributions are typically tax-free upon retirement. Qualified plans, such as 401(k), S and IRAs, offer significant tax advantages during the accumulation phase, including tax-deductible contributions, for traditional plans, and tax-deferred growth of earnings. However, the primary characteristic that is not true is that distributions are typically tax-free upon retirement. Instead, distributions from traditional qualified plans are generally taxable as ordinary income when received in retirement, as the contributions and earnings were tax-deferred. Only distributions from Roth-style qualified plans, which are funded with after-tax contributions, are typically tax-free in retirement if certain conditions are met. Question 17. An adjustable life insurance policy allows the policy owner to A. Adjust the face amount of the policy, but not the premium. B. Adjust the premium payments, but not the face amount. C. Adjust both the face amount and the premium payments. D. Adjust the investment options within the policy. Answer: C. Adjust both the face amount and the premium payments. An adjustable life insurance policy is a flexible type of permanent insurance that allows the policy owner to make changes to both the policy's face amount, death benefit, and the premium payments. Within certain limits, the policyholder can increase or decrease the death benefit or increase or decrease the premium, often affecting the policy's cash value accumulation and duration. This flexibility makes it adaptable to changing financial needs throughout the insured's life. Think of it as a policy that can be adjusted to fit evolving circumstances. Question 18. Under California law, a life insurance producer's license may be suspended or revoked for all of the following reasons, except A. Misrepresenting the terms of a policy. B. Failing to respond to an inquiry from the commissioner within 30 days. C. Conviction of a felony involving dishonesty. D. Being found liable for a civil judgment related to a personal auto accident. Answer: D. Being found liable for a civil judgment related to a personal auto accident. A civil judgment related to a personal auto accident, while potentially having financial consequences, is generally not a direct cause for suspension or revocation of an insurance producer's license. The California Insurance Commissioner has the authority to take disciplinary action for violations that demonstrate a lack of trustworthiness or competence in the business of insurance. Misrepresentation, failing to respond to official inquiries, and felony convictions involving dishonesty directly relate to an agent's fitness to hold a license and are grounds for disciplinary action. Question 19. Which life insurance rider guarantees the policy owner the right to purchase additional life insurance at predetermined intervals without proof of insurability? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Accidental death benefit rider. D. Payer benefit rider. Answer: B. Guaranteed insurability rider. The Guaranteed Insurability Rider, GIR, is a valuable addition to a life insurance policy that grants the policy owner the option to purchase additional amounts of life insurance coverage at specified future dates or events, like marriage or birth of a child, without having to provide evidence of insurability. This means that even if the insured develops a serious health condition, they can still increase their coverage. This rider is particularly beneficial for younger individuals who anticipate needing more coverage as their responsibilities grow. Question 20. A policy owner stops paying premiums on a whole life policy and chooses the extended term non-forfeiture option. Which of the following is true regarding this option? A. The policy continues as a paid-up whole life policy for a reduced face amount. B. The cash value is paid out, and the policy terminates. C. The policy continues for the original face amount for a specified period of time. D. The policy's cash value continues to grow, but no death benefit is paid. Answer: C. The policy continues for the original face amount for a specified period of time. The extended term non-forfeiture option uses the policy's existing cash value as a single premium to purchase a term life insurance policy for the original face amount of the policy. The term coverage will last for a specific period, which is determined by the amount of cash value available. Once that term period expires, the coverage ends. This option allows the policyholder to maintain the full death benefit for a limited time without paying further premiums, which can be useful for temporary needs. Question 21. Which statement accurately describes adverse selection in the context of life insurance? A. The tendency of healthy individuals to purchase more insurance coverage. B. The tendency of individuals with a higher than average risk of loss to seek insurance more often. C. The process by which an insurer selects applicants based on favorable risk profiles. D. The marketing strategy used by insurers to target low-risk individuals. Answer: B. The tendency of individuals with a higher than average risk of loss to seek insurance more often. Adverse selection is a fundamental concept in insurance that refers to the tendency for individuals who are at a higher risk of loss to seek out or continue insurance coverage more often or in greater amounts than those who are at an average or lower risk. For example, someone with a serious health condition might be more motivated to purchase life insurance. Insurers manage adverse selection through careful underwriting and risk assessment to ensure their pool of insureds is balanced and premiums adequately reflect the risks. Question 22. All of the following are typically characteristics of variable life insurance, except A. It has a guaranteed minimum death benefit. B. Its cash value fluctuates based on separate account performance. C. It requires the agent to hold both a life license and a FINRA securities registration. D. The policy owner bears the investment risk. Answer: A. It has a guaranteed minimum death benefit. Variable life insurance is a type of permanent life insurance where the cash value is invested in a separate account, and its performance is tied to the underlying investments. While some variable life policies might offer a guaranteed minimum death benefit, it is not a universal characteristic of all variable life policies, and many simply have a fluctuating death benefit based on the separate account's performance, though it usually won't fall below the original face amount. The key characteristics are variable cash values, investment risk borne by the policy owner, and the requirement for a securities license for the selling agent due to the investment component. Question 23. An applicant for a life insurance policy intentionally fails to disclose a pre-existing medical condition on the application. This act is an example of A. Estoppel. B. Waiver. C. Concealment. D. Misrepresentation. Answer: C. Concealment. Concealment, in insurance terms, refers to the intentional withholding of material facts that an applicant has a duty to communicate. If an applicant deliberately fails to disclose a pre-existing medical condition, knowing it is relevant to the insurer's risk assessment, they are engaging in concealment. This differs from misrepresentation, which is a false statement of fact. Both concealment and material misrepresentation can give the insurer grounds to void the policy, especially if discovered within the contestability period. Question 24. What is the primary purpose of the California Financial Solvency Standards Board, FSSB, as it relates to life insurers? A. To approve life insurance product rates and forms. B. To develop and recommend financial solvency standards for insurers to the Commissioner. C. To investigate consumer complaints against life insurers. D. To manage the assets of insolvent life insurance companies. Answer: B. To develop and recommend financial solvency standards for insurers to the Commissioner. The California Financial Solvency Standards Board, FSSB, is an independent body that advises the California Insurance Commissioner. Its primary purpose is to develop and recommend financial solvency standards for all admitted insurers, including life insurers. These standards aim to ensure that insurance companies maintain sufficient financial strength to meet their obligations to policyholders. The FSSB's recommendations help the Commissioner regulate insurers' financial health and prevent insolvencies, thereby protecting consumers. Question 25. Under California law, when does the incontestability clause begin to run on a life insurance policy that is reinstated after a lapse? A. It runs from the original issue date of the policy. B. It runs from the date of the reinstatement application. C. It runs from the date the policy is officially reinstated. D. It runs from the date of the next premium payment after reinstatement. Answer: C. It runs from the date the policy is officially reinstated. When a life insurance policy is reinstated after lapsing, the incontestability clause generally starts anew from the date of reinstatement. This means that the insurer has a new contestability period, typically 2 years in California, during which they can investigate and potentially deny a claim based on misrepresentations made in the reinstatement application. It does not revert to the original policy issue date, as new evidence of insurability may have been required for reinstatement. This allows the insurer to protect itself against new material misstatements made during the reinstatement process.